Today I'm going to talk about what investment strategy is right for you, whether buying a home with 20% down, all cash, or going low down payment. So if you don't know what down payment is good for you or what strategy might work best for you, then stay tuned because I'm about to cover it all right now. So let's talk about down payments. Traditionally, we have the 20% down payment, which everyone says, oh, you need to save your 20% down payment. You don't. You really don't need to. It really depends on the strategy. Yes, a 20% down payment can increase your affordability. It could also show the lender that you can save for long-term goals and yada, 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 but ultimately it doesn't really matter because there's plenty of clients that I've helped and that other team members have helped where they have the ability to put cash, but they're approaching it from an investment standpoint. And when you approach buying a home from an investment standpoint, less cash out of pocket is usually better depending on the interest rates. You're curious to learn more about what it's like to live in San Diego or any of the neighborhoods, please feel free to subscribe down below. My goal is to create value for everybody to have, whether it's neighborhood walks, things to do in local areas in San Diego, or how to buy a home. Feel free, you can reach out to me or my team anytime. Numbers right down below. We're here to help. You give us a call, text, email, whatever works for you. We're here. Today I'm going to talk about mainly the upsides, downsides, and kind of the happy mediums. So let's first cover the downsides. The downsides to putting down less than 20% on a mortgage or a home purchase. Two things mainly. One, you're going to have private mortgage insurance, which adds anywhere, from a couple $100, could be $500, $600 plus, depending on the home. But anything less than 20%, you're going to be adding that private mortgage insurance. And the only way to avoid that is either put 20% down, or you can pay off your loan to value ratio, meaning you pay off 20% of your loan, leaving 80% of the value of the home still vested with the bank. So that basically removes the private mortgage insurance, or you gain equity and you basically offset, your equity rises and you offset that 20% ratio. Another downside to not putting 20% down would be less affordability. A lot of lenders will not lend a larger lump sum of money. So essentially what you're doing is you're taking away from your affordability. Now, for first-time home buyers, the non 20% down is a great option because like myself, when I bought my first home, it was hard to get 20% down, especially here in Southern California. I mean, I was saving for about 8 years, and I could have been much further ahead in the game. So I think it's actually pretty important to not necessarily wait to 20% down. If you could do it at 3%, then freaking do it. Like, what are you waiting for? But anyways, so that's downsides. Let's talk about upsides of not putting down 20%. So if you don't put down 20%, don't think it's all bad. No, there's some killer upsides. So one of them, if the home appreciates, like I was talking about earlier, the home appreciates around, real estate as a whole in the United States appreciates roughly about 5% throughout the United States. So if you take that over the course of several years, now what you're doing is you are now offsetting that amount. While not only you're paying down your mortgage, you're also appreciating in value. So here comes your 20% when, let's say, you really only paid down, I don't know, 10% for easy numbers, but then your home goes up 10% over the course of 2 years, and now you've matched that 20% loan to value ratio or 80% loan to value ratio. You've paid off 20% of the home, and now your principal mortgage insurance falls off. However, keep in mind, if you do an FHA loan, like I did, for example, on my first home purchase, you are going to need to refi out of the FHA loan. As soon as you hit that 20%, you're going to need to go get an appraiser, talk to your lender, and get refinanced out of the FHA loan. If you were to go a conventional loan from the beginning, like I usually try to advise most of the clients to go on a conventional side, mainly in this market. One, because things are appreciating so quickly, and homes necessarily either fixer-uppers or homes that are turnkey, doesn't really matter because you get into a home. For example, a client of mine that bought here in Oceanside, their home's already gone up 100 grand, and they're well above that 20%. They only put, I think, 5% down, so they're killing it, and they don't even have to refi because they did a 5% conventional loan, which basically is like a normal 20% conventional loan. However, that PMI, the private mortgage insurance, gets tacked on to that. Once you get to the 80-20 rule, we'll call it, essentially the private mortgage insurance just drops off. So thus lesser payment, more flexibility. You can rent out your place, you can non-owner occupy it, move on to the next. So it's really all about finding the happy medium, what works best for you. If you're long-term and you have the money and you don't really care about keeping money in your pocket, or you have extra money for expenses when you do buy a home, a lot of first-time home buyers, heads up, pro tip, keep money in your pocket because you're going to be a frequent flyer at Home Depot. You're going to be on a loyalty program at Lowe's and whatever, Ace Hardware and everything else, because you're going to be cats. You're going to be all over the home improvement. Doorknobs are going to break. Things are going to crack, and it's an endless battle when you first get your first home. But oh my God, it's awesome. It's awesome to buy your home, but there's definitely a learning curve. So keep the money in the pocket. That's my pro tip for first-time home buyers. Now, if you're okay on funds and you have the ability to put 20% down and still have some cash in hand for those unexpected expenses, that's killer for you. Bravo. Most of us don't. I didn't. So nevertheless, if you can put, let's say, 5% down, keep another 15% in your pocket, reinvest it somewhere else. Approach buying a home as an investment versus a necessity. Yes, it's a necessity to live in a home, but if you approach it from an investment standpoint, you're going to build long-term wealth much quicker than you would if you're just throwing all your cash and now you have to resave everything you did to buy your next property or reinvest into the next thing or Bitcoin or whatever's going on in the future. I don't know, quadcopters or hoverboards. So yeah, so getting to that happy medium is crucial. Finding out what strategy works best for you. Is it the 20% down? Is it the 5% down conventional loan? Is it an FHA loan? Is it private money? Whatever it is, you need to find the happy medium for you. Approach buying a home as an investment. My recommendation, keep that cash on hand and always be ready for the turns. Everything's cyclical. That's the way it works. If you're ready for the downside, you're going to be way better off when the market turns, and you will not be crunching numbers trying to figure out if you can make your mortgage payment or not. So like I said, whether it's 20% down or anything less than that, that's good. Do your thing. Give us a call. The number's down below. If you have any questions or want to go over your specific situation, we're happy to do so. You can reach us at 760-456-9222, and our team members or myself will pick up the phone and we'll help guide you and talk through your specific situation.